Hello tax students, this is your teacher Roy again, this time with a video regarding how to calculate your tax when there is a capital gain or even a loss. So what you're looking at is my personal homepage, and here and also on our Laulima class homepage should be a link to take us to the IRS site where you can download fillable PDF files. So here where we're looking at the current year, the common forms are listed down the screen, and if you cannot see what you want, you can click on this Find All button and then type in this text box here the form number or the schedule that you want to search for. That's for the current year forms and schedules, but if it's a prior year form or schedule, you probably have to use this tab here. So let's take a look at our common 1040 form, where we're learning in our class the different types of income that you can fill in here, including, like we learned way back in our prior tax class, the qualified dividends that get taxed at lower rates. That's reported to us on a form 1099 DIV, where here is the qualified dividend that's included in this ordinary dividend box. So when you're filling out the 1040 form, that ordinary here also includes the qualified dividend here. And we learned that the qualified dividends are taxed at lower preferred rates. And all of this tax calculation is done on a form, or really a worksheet called Qualified Dividend and Capital Gain Tax Worksheet. Okay, again, the capital gain, or really the qualified dividends, are taxed at lower rates. But now in our chapter 7, we're learning that possibly long-term capital gains are also taxed at lower rates. And we need to report our capital gains or losses on a Schedule D. So let's take a look at a Schedule D, where it's divided up into short-term, where the asset sold was held for less than a year, versus long-term gains and losses held for more than a year. Now, any specific sale, the transaction for any specific sale, is not reported directly here on this Schedule D, but it's reported first on a form 8949. You can see there's different situations, A, B, C, and way down here for long-term, D, E, F, reported on that 8949. Now, if the only sale you had was a stock sale with a broker, and you bought that stock initially with that broker from the year 2011 forward, the broker will issue out a form 1099B, yeah, a broker form, where the broker will report the date you bought the stock with them, the date you sold to them, that would be the current year. You get this form, how much you got, proceeds, and the original cost of that stock. And of course, the difference between those two amounts would be the gain or the loss. Now, if this is the situation, all of this information will be reported to you and the IRS. So the IRS says you don't have to report all this detail. All you gotta do on the Schedule D is use this line 1A. The total proceeds of all of that type of sales, the total cost of all of that type of sales reported to you on that 1099B, and then the difference would be the gain or loss, be it again short term versus long term. Okay, and that keeps things simple. You don't have to do this 8949, yeah? This 8949. If again, back here on the 1099B, the date, acquired, sold, proceeds, and costs are all reported to you and the IRS. Now, if you didn't buy this stock that was sold with the broker would not possibly have the date acquired and the costs. And then you would have to find the information for your costs. Also, if the stock was purchased from this broker, really the name you see here, the pair's name, prior to the year 2011, they're not required and will not report the cost information to the IRS. Although they may report it to you, the investor, the taxpayer, it's not going to be reported here to the IRS. In that case, on Schedule D, you do have to fill out this form 8949. Yeah, 8949. Again, if all that cost information and proceeds was reported to the IRS, you just fill up this line 1A or long-term 8A and not fill out the 8949. Now let's take a look at the 8949. It kind of mentions that cost information up here being reported to the IRS in Form 1099. Now there's different situations, A, B, C for short term, and down here next page, D, E, F for long term. Situation D, the first one for long term, and situation A, first one for short term, says that cost information was reported to the IRS, but you choose to report it again over here, all this detail, 1 row per sale, 1 row per transaction. In situation B, the cost basis was not reported to the IRS. Okay. Likewise on situation E here, the cost was not reported to the IRS. So now you are required to fill out this form 8949. In situation F and situation C up here, there was no 1099 issued, not the sales price, not the cost. So again, you have to report everything down here for short term and everything down here for long term. Now, if you check off, let's say this box A here, that means you're going to put only here everything that meets this A. And if you have a situation with B, you gotta get another 8949 form and check off the B box and only put B transactions here. And likewise, if there's a C type, you get another 8949, check off the C, and only put the C type here. Likewise with this second page here for the DEF, yeah, 1 per side or 1 per situation. So once you totaled up all the A's down here for short term, you would carry it back to Schedule D and put it right here in this line here, yeah, for that A short term. Again, going back to the 8949 for B, which the cost wasn't reported to the IRS. They really want you to fill out that form now, that's your cost information, and then the total fill out here. Okay, so you then take a subtotal of all the short term, subtotal of all the long term, and you get a grand total here. And this is the amount, again, if it's a gain, you're reporting back on line 13 of the 1040 form. Now, when you get your grand total of all your income and deductions, that's your taxable income down here. We've been learning that there's different tax rates here in Chapter 7 for capital gains and losses. So, in the case of a, let's go to the worksheet here. The worksheet for Schedule D. If you have a long-term capital gain or net long-term capital gain, that net long-term capital gain could be taxed at 0, here's a 0%, or could be taxed at 15%, here's the 15% rate, or if you're in a high tax bracket, like when your income is like this high total, maybe your net long-term capital gain is taxed at 20%. So this worksheet accommodates all of those different tax rates. But if you take a look at Schedule D, if I can find that again, here on page 2 of Schedule D, we've learned in Chapter 7 there's something called collectibles, and those are taxed at 28%. And also, we learned in Chapter 7 something called unrecaptured Section 1250 gain, which is taxed at 25%. So those rates, the 28 and the 25%, are also on this Schedule D worksheet someplace. Here's the 28%. And somewhere maybe the 25%. I can't see it right. Oh, here it is, right here. And then the rest of the taxpayer's taxable income is taxed using the tax table, if that rest is under 100,000. And if it's more than 100,000, we learned way back in our previous class, it's taxed using the tax rate schedule. And you add up all these different taxes, taxed at the different rates, and only then you take this amount and you put it on your 1040 form back here on line 44. Okay, so you just don't take your taxable income here, line 43, and use the tax table or tax rate schedule. You gotta use this worksheet when you have net long-term capital gains and also qualified dividends. One more place where you can have capital gains would be, let's go to the 1099 DIV form. Here's your qualified dividends, again taxed at lower rates, but also right here is a capital gain taxed at lower rates. Maybe even this gain here, if you have any, taxed at 25%, or the collectible at 28%. So all of these have to be entered somewhere in your tax return too. In the case of capital gain distributions, if you take a look at Schedule D under the long-term section, right here is possibly where you would enter the capital gain distribution, adding it up with the other long-term gains. Okay, so this is Roy again with a video going over how the capital gains are taxed.